I'd like to introduce our first guest, Nouriel Roubini, who's Professor of Economics at New York University's Stern School of Business. He's actually also a former colleague of mine at Bob Rubin's Treasury Department too many years ago. Nouriel, welcome to Global Invest.
Great pleasure being with you today, Stephanie.
The name, the phrase, the tag Dr. Doom, has stuck with you for a long time, and you're not making any great effort to shake it off, because I know you have a pretty stark forecast for the global economy coming out of the COVID crisis. Maybe not now, but in the near future, you see the conditions for a decade of global depression. Just talk us through what makes you give that forecast, even if we do see quite a rapid bounce back in some economies over the next few months.
Well, I would say that for the time being and for this year, my view is that the recovery is going to be anemic, subpar, below trend, more of a U-shaped recovery rather than a V-shaped recovery that is the one of the consensus on Wall Street. And the reason is that there is going to be a painful process of deleveraging both by the corporate sector and the household sector that have to be spending less, saving more, and doing less investment, capex or residential investment. But that's a story for this year and next year. What I pointed out is there are some forces in the global economy, there are some imbalance and risks that have been ongoing for a decade, and the coronavirus crisis has exacerbated them. And these may be leading over the next few years to something that I would call the Greater Depression of the 2020. If I had to summarize it, I would say in brief, number one, there are 10 factors. One is debt and deficits are going to lead to defaults over time with a massive buildup of private and public debt. Secondly, we have demographics with aging of population, both in advanced economies and emerging markets, an unfunded healthcare system, and now we'll have to spend more on coronavirus and other types of pandemic. Three, in the short run, there's a slack in goods market, labor market, real estate, commodities that's leading to deflation. And then the way we're going to be fighting it is by debasing currencies, essentially effective monetization of fiscal deficits. But this monetization of fiscal deficit that prevents deflation in the short run, over time might lead to stagflation, a combination of stagnation and inflation, because we're going to be facing now with a significant amount of negative supply shocks in the global economy. One of them is deglobalization, decoupling between US and China, fragmentation of the global economy, and having balkanization of the supply chains. The other one is there will be a slower pace of technological innovation, even if we're going to be seeing ongoing disruption. So if you impose monetization of fiscal deficits in an economy with negative supply shocks, because we deglobalize and there is less technological innovation because of the decoupling between the US and China, eventually the inflation genie can get out of the bottle. In addition to deglobalization, I think there is also a democracy backlash. More and more countries are becoming more populist, more nationalist. They're going to try to defend their own, protect their own firms, their own workers, and that populist policy, of course, are going to have a negative impact between US and China. This Cold War is going to become a colder war, and that's going to lead to a division in the world economy between a group of countries close to the US and the one close to China. Finally, I think there is going to be a digital rivalry between US and a major rival of the United States. That's going to lead to global cyber warfare, and the big tech sector is going to become a weapon in trying to contain the strategic enemy of the United States. And finally, there are what I call the deadly man-made disasters. They're not natural disasters, pandemics, or global climate change, and the costs coming from pandemic and the global climate change are going to be becoming more severe over time. So these are 10 deadly trends that were ongoing before this crisis. They're going to be exacerbated by the crisis, and I think that by the middle of the decade can lead us to a greater depression.
There's so much to unpick in that, but I know that what you said at the very beginning will be perhaps, at least short term, most interesting to people watching, because you're saying we could get something like a V-shaped or maybe a U-shaped recovery coming out of this. And frankly, people in the markets could do pretty well, continue to do well for quite a long time. How long do you see this system continuing in this way before the kind of the underlying problems that you've spoken to, which, as you suggest, have been going for a long time, really come back to haunt people and start damaging investors, let alone the rest of the world?
Well, in the third quarter of this year, there's going to be a recovery after a very severe recession in the first and the second quarter. So for a quarter or two, it may look like a V-shaped recovery, but the way I differ from consensus is that consensus believes that by next year, the V-shaped recovery is going to continue, that growth is going to be something like 6% in the United States, 3 times as much potential, while I see the recovery being strong only in the third quarter and then fizzling out by the fourth quarter and then becoming very anemic by next year. And the main reason is not just the fact we're going to have a second or a third wave, but if you think about it, after the global financial crisis, firms that were firing workers and they rehired them in a way that was different from the past, not formal jobs, not full-time jobs with good wages and good salaries and benefits, but gig workers, part-time workers, hourly workers, freelancers, contractors. This time around, we've shed already something like between 20 and 30 million jobs. And when the rehiring is going to occur, that type of precarious job is going to become the norm. Most firms are highly leveraged. They have to survive and thrive by cutting costs and saving more. How they're going to do it? By reducing labor costs and first firing people and then rehiring them in a more flexible way. The trouble is that what's my labor cost is somebody else's labor income. And as the corporate sector deleverages by spending less, saving more, and doing less capex, then there'll be a more anemic recovery of labor income because there is more precarious jobs. There'll be a very large unemployment rate. And even the households have to be more cautious. They have to be more risk averse. 40% of US households have less than $400 of liquid cash in the case of an emergency. Your income is going to be more precarious, it's going to be weaker. Lots of people are going to be barely having any jobs. They'll have to save more and spend less, and they'll have to do also less investment, meaning residential investment. So there'll be an option value weighting both for the corporate sector and the household sector. There'll be more risk aversion. That implies less spending, more saving, less capital spending, less residential investment, and that's why the recovery is going to become like a U. Currently, markets are pricing in a V-shaped recovery of the economy. That's why they rallied so much. Of course, they rallied a lot also because of the liquidity by the Fed. But I think that people are pricing in expectation for recovery of growth and earning that are totally not consistent with the fact that the recovery of the economy is going to be a U rather than a V.
Just to push back a bit on some of that, what you've described, one way of putting it would be that there is a system that came into this that had flaws, many of which have inspired populism, the rising inequality, and you believe that the response to the crisis will be exacerbate those things. And that's certainly what many people are forecasting, that we're going to see a further inequality and a further damaging of employment rights and labor income, which will ultimately, in a kind of Marxist way, sows the seeds of its own destruction. But there is a view that says, you know what, this has been a wake-up call, this crisis, and even the people who doubted before that you need major reform to make this a more inclusive world are now going to realize they have to do something different. Do you give any credence to that, whether in the US or anywhere else, that actually you could have a reset coming out of this, following on some of the wage subsidy programs, for example, that we've seen that have, in the US, put money into poorer people's pockets in the last few months, actually pushed up their spending in the last few months, so it's not far below where it was before the crisis, even if they've lost their jobs. Can you see a reset coming out of those kind of policies we've seen in response to COVID, maybe in Europe, that helps to slow down or even reverse some of those trends that you're talking about?
Well, my view is that since the corporate sector in the US, but also in many other advanced economies and emerging markets, is highly leveraged, many firms right now have been, for the last decade, building up debt and leverage, CLOs, leverage loans, high yield, high grade, fallen angels. We're speaking about trillions of dollars. Share buybacks, they increase debt and reduce the equity of the corporate sector. So many firms right now are either bankrupt or on the verge of bankruptcy. They have to do and take action to try to survive. And what are the actions that have been taken in the United States? We lost in the United States in the last few months many more jobs that we created in the last decade. Depending on how you measure it, we have had between 20 and 30 million people have lost their jobs. And the corporate sector first fires them, and then when they're going to be rehiring them, they're going to do what they've done after the global financial crisis, gig workers, contractors, part-time workers, hourly workers, freelancers. That was what happened 10 years ago when the corporate sector was not highly leveraged. This time around is much more leveraged, and therefore the reaction is going to be one of continuing more of the same. It's going to create more precarious jobs, more gig workers, more economic uncertainty for labor, and more need then for the household sector to spend less and to save more and to do less investment in real estate. That's a reality. I don't see a radical change in the United States in terms of economic policy. Yes, if Trump were to be losing the election, that's an if, and if Biden were to be coming to power, maybe economic policy are going to be becoming slightly more progressive. But there are major forces, including also technology. The digital disruption is going to imply that over the next few years, there'll be many more jobs that are being destroyed, not just by globalization, trade, or migration, but by technological innovation that is capital intensive, skill bias, and labor saving. That's going to be disrupting millions of other jobs. And even if there's going to be reshoring activity for a higher cost, then that reshoring is going to imply essentially production that is even more capital intensive, like, for example, more automation, more robotics. The factory is going to be reopened in North America, not going to be full of workers, going to be full of robots. So unless there is a very radical change in economic policies, the trend of globalization, of technology, of the weakness of labor, of unions, and so on imply that labor is weak, capital is mobile, and the entire system has been essentially one where income has been going on from the workers to capitalists, from wages to profits, and from those who spend more to those who save more. And yes, eventually you get this Marxian underinvestment and underconsumption if you have that redistribution of income. But the inequality has been rising, and I'm not sure that these major trends are going to be reversed anytime soon.
Just moving on to the debt piece of your analysis, because that's one of the things that's the forcing event is when the global economy, in a sense, cannot continue to carry the debt that it's carrying, and that causes a threats to market confidence and much else. I think there's been a view, perhaps unspoken, those who have a more optimistic view of the next 5 to 10 years, looking and are investing in the markets on the basis of it, that we're either going to have more of the same coming out of this, namely very low inflation, low interest rates, but with that, the affordability of this much higher debt stock, corporate and public debt around the world, or we might get inflation and that might cause some bumps down the road, but it will at least make that debt easier to grow out from underneath. Your view is actually that's just too optimistic, that you can have the inflation without really resolving the debt issue. Is that right?
Well, my view is that certainly in the short run, I agree that there are more deflationary rather than inflationary pressures. There is a massive slack in goods markets, in labor markets, in real estate, in energy and commodities. So this year, next year, there'll be low inflationary and deflationary pressures. But I've pointed out, however, is that we're doing massive monetization of fiscal deficits, effectively already in variants of MMT or helicopter drop of money. And if the shocks that hit the economy are demand shocks like the global financial crisis, then monetization of fiscal deficits prevents stagnation and deflation. But what I'm pointing out is there'll be major forces that are going to imply negative supply shocks in the global economy in the next few years, because there were two major forces that kept inflation low for the last decade. One was globalization, and now we're in a process of deglobalization. And the second one was major technological innovation that were also increasing productivity, reducing costs. And right now we're going to have a digital wall being built between US and China, and we're going to have two separate AIs, two separate internets, two separate 5Gs, two separate telecom systems, and so on and so on. And for example, we may for geostrategic reason not want to use the Huawei 5G, but the Huawei 5G is 30% cheaper than the one of Nokia and Ericsson, and 20% more productive. So if we're going to install a 5G network, there's going to be not Huawei is going to be 50% more expensive than before. That's a negative supply shock. So both technology and deglobalization imply negative supply shocks. Now, last time around, when we had negative supply shocks and we had easy money, easy fiscal in the 70s with the two oil shocks of 73 and 79, we ended up with inflation, stagnation, recession, and inflation. So either this debt become unsustainable, or if we're going to try to wipe them out with inflation, then we're going to have a trap of stagflation. And you remember the misery index in the 70s and what happened when you have high inflation and you have an economic downturn. Certainly the 70s was not a great model. So either way, we're going to be in a trap.
It seems like you just mentioned the deglobalization as one of these fundamental negative supply side shocks, which is a good opportunity to have the polling question for this session, which should be popping up on your screen pretty soon. And the question is, what's next for US-China trade? Either the phase one will move ahead, the parameters will be changed and agreed, the US will pull out, or China will pull out. I suspect if China did pull out, the US would immediately announce that they pulled out first, but I won't even go there. We should, but in terms of just pick your A, B, C, or D, and we'll wait a few moments for the result of that. I mean, Nouriel, I guess I feel like I'm just constantly putting the Pollyanna view to you, but it's one always has to look for chinks of light in your analysis. Historically, people who have bet against integration have tended to be wrong, especially even at times where we felt that there were irrevocable forces of division. I mean, of course, we had the last great period of globalization was broken up by World War I and then World War II. But many people would say, looking at the trends we've had over the last few years, even if globalization slows down, it's not going to reverse, and it could still continue to bring enormous benefits, particularly perhaps to developing countries and countries across Asia especially. So what is it about now that you think is different from the other times when people have declared the end of integration?
Well, as you pointed out, there was a reversal of globalization that occurred after World War I and then with the onset of World War II. And in both cases, there was the rising of a new power, first Germany and then Japan. They were strategic rivals of the United States. And as you know, Graham Allison, who wrote a book about the Thucydides trap and whether US and China are going to avoid it. We have a new rising power that is China, that has a different economic, social, and political system from the United States, and you have an existing power, and this Thucydides trap is ongoing. There's a beginning of a Cold War between US and China. This Cold War is becoming colder. If you see what's going on technology, on trade, on FDI, on investment, on data, on information, on financial arrangement, on internet, on pretty much every aspect of the economic relationship, there is now a beginning of a decoupling. And it's not just decoupling, but then both US and China are going to say either you are with me or you are against me. and therefore either use my AI or their AI, my 5G or the other 5G. And therefore the rest of the world is going to be in a very difficult situation having to choose between US and China. So what's different is, like in the past, when you had the rise of a new power facing an existing power, we had initially a Cold War, and in the last two episodes, actually, we had a real hot war. Now, I'm not predicting for the time being a hot war between US and China. I think that given the asymmetry of power, conventional and unconventional, between US and China, that's unlikely, but we're seeing every day an escalation of this Cold War. And that's already leading to a process of deglobalization, and it's not just deglobalization on trade, but most importantly on technology. And today those 5G networks are running our phones, but tomorrow they're going to be running our system of, say, autonomous vehicle, making sure that millions of them don't hit each other. And tomorrow pretty much every piece of consumer electronic in the Internet of Things is going to have a 5G chip, even your lowly Chinese toaster or coffee machine or microwave. And therefore, if you're not going to use the 5G of China, you're not going to also want to use the toasters or microwaves or coffee machines of China, because they're potentially a listening device if you believe that there is a backdoor from Huawei's 5G to the Chinese government. So that's where the war on tech becomes also a war on trade, and it's going to only escalate over time. Unfortunately, I think that's the trend we're facing. We already were in peak globalization after the global financial crisis, and we had inward-oriented nationalistic policies in many parts of the world because of the global financial crisis. Now you have all this geopolitical layer with China is going to exacerbate the process of deglobalization. Of course, it's not black and white. I'm not saying there's not going to be any trade of any sort, but we are in a trend towards gradual but persistent deglobalization.
We should get to some of the questions that people have put. And Peter Goodman had a question. We focused on the US and the world. We haven't thought about some of the differences across countries, at least within the developed world. And he points out that countries in Europe have taken different approaches to the pandemic when it comes to the economic impact of the pandemic. Focusing more on employment in the case of many European countries. Which do you think is working better? Which do you think is best helping economies move out of this crisis and maybe even reduce some of the threats that you're talking about?
Well, there is a difference between the US labor markets and the European. The US labor markets are more flexible. So in the US, firms have decided essentially to fire at will their workers, and then we've provided to these workers significant amount of large but temporary unemployment benefits, while in Europe you have a system of reshoring where you keep most of the employees on a payroll, and then you give them between 2/3 and 3/4 of their salary, and the rest of it is shared between the firm and the government. And that's why in the US, the unemployment rate effectively measured has gone from 3.5% to 17%, while in Germany, there's been only a very modest increase in the unemployment rate, and also in other parts of Europe. I would say that usually labor markets in Europe are criticized for being rigid, by having large hiring and firing costs. But in a situation like this one, with a shock of this sort, actually the response of Europe is a better one. But by keeping employment, then the recovery of jobs and income is going to be slightly more robust. While in the United States, we've had literally a bloodshed, and we've lost in 3 months the entire sets of jobs, 22 million that were created in the last decade. So this time around, actually, I think that the European labor market and the institutions are giving you a better response, going to lead you to a slightly better recovery than the United States. But the shock in Europe has been heavy, and probably the economic downturn in Europe is going to be as severe, if not more severe, than the United States, because, of course, the COVID hit very hard countries like Italy and Spain and some of the other ones in the periphery of the Eurozone. So in spite of this different setting of the labor market, the economic downturn in Europe and the Eurozone is not going to be less than the United States. It's only the difference between how much the hit is taken directly by labor in one way or another one.
I guess it also depends on how much you think of this shock from COVID as being one that causes structural change in jobs, or you actually want people to move into new jobs as a result of this, or whether you want really just to hold on to the jobs they had. And we're only going to see that over time, how much disruption, structural dislocation has been caused by this crisis. But it raises a broader question. I think this will be my last question to you, and some of the people with their own questions, some of the people watching you have wondered, for example, Piyush Rakecha, that the same job loss fear was raised when PCs came in and replaced all the paperwork. Is it not possible that we will find new jobs like we found the last time? I guess just to add on another question that somebody had is, could there be good news here? I mean, many people are investing in high-tech companies that seem to do fantastically well. It seems odd to say we're going to have lots of technological change, but it's not going to produce growth and it's not going to produce income for someone, which might then be redistributed. Is there no good news here?
Well, the difference is in the previous industrial revolution, jobs went from agriculture into the industrial sector and from the industrial sector to the service sector. But what's happening right now is not only that the factory of the future is going to be a bunch of robots and machines and just maybe one person manning these machines, but now the same process of AI, robotics, automation is completely disrupting tons of jobs in the service sector, from retail to transportation to education to government services to pretty much anything under the sun. So those who say we're going to create other jobs, is not clear what are going to be those jobs in the future are going to be created. For every job that is created by Amazon, there is on average 10 jobs in retail that are disappearing. So I think that's a difference compared to the past. And then for the time being, all this technological disruption has not led at the macro level to data that are showing an increase in productivity. Eventually, of course, if there's going to be a significant technological disruption, there may be an increase in productivity. The economic pie is going to become larger, but since technological innovation is capital intensive, skill bias, and labor saving, those who own financial and real capital are going to do well. Those that are in the top 20, 30% of distribution of skills, education, human capital are going to do well. But if you are a blue-collar worker with low skill or medium skill, but now even if you are a white-collar worker with low skills or medium skills, your income and your job is going to be disrupted completely by technology. And therefore, the issue is not whether the economic pie is bigger, but what's going to be the distribution of the benefits. And distribution of benefits is going to go to capital and those that are very, very high skilled. And everybody else is going to be left behind. That's why we have the rise of populism. Populism is driven in part by this income and wealth inequality. It's driven not only by globalization, but also by technological disruption that increasingly are threatening white-collar jobs as much as blue-collar jobs. And therefore, the tension and the political backlash against it is going to become severe. So the pie is going to be bigger. The distribution of the benefits is going to become even more uneven.
Okay, well, Nouriel Roubini, I guess so. The answer to is there any good news? It's hard for you to see the good news, but we will be seeing if Professor Joe Stiglitz has a different perspective later on. But in the meantime, Nouriel Roubini, thank you very much for joining us.